What's happening, guys? Welcome back to another video. This one's going to be about breakaway gaps, or breakaway fair value gaps. This is how we label them on the chart, a breakaway gap. This one's going to be a nice and short video. It doesn't really take too much explaining on what a breakaway gap actually is. So a breakaway gap is a single candle formation, and it happens when price displaces through a swing low or a swing high, or a short-term low or a short-term high, and the actual candle what displaces past the short-term low or short-term high actually leaves a fair value gap in the middle of it. So this candle is displaced lower, there will tend to be a fair value gap here. And what usually happens with these breakaway gaps is that they are respected, and every PD array after this is also respected towards the draw. We would be looking for an entry off of this breakaway gap down to the next draw. Now we want to see it paired ideally with a mitigation block or a breaker block. A valid stop for these is actually above the breaker block or mitigation block, or you can actually run it at the breakaway gaps high or low, and that would be valid, targeting the next draw on liquidity. So what is a valid breakaway gap? A valid breakaway gap is one that's within a macro time or macro window, which is what we trade. We only trade the macro window, so if you see a trade within that is in line with your bias, then that would be a valid breakaway gap. Now I'm actually going to show you an example of a trade that I took, and this was on the 18th of September within the first macro. Here you can see this single candle broke above this short-term high or swing high, and it actually closed above, and in the middle of that has created a fair value gap. This is your breakaway gap, and you would mark it like this. Now as you can see, you've also got a bullish breaker here which sits, and it's paired with the breakaway gap. Now our entry wants to be off the first tap of this fair value gap, and a valid stop placement in this case is at the actual candle low of this breakaway gap. And since you've got a breaker block above and it's not actually below this breakaway gap, then the stop is valid to have it at the actual candle low of this breakaway gap. Now the higher time frame draw was this high here, and let's just see the fair value gaps, what we have respected. So you can see here we've not disrespected this bullish PD array. We also have another bullish PD array here which we've respected up to the draw. Now this breakaway gap is also paired with market structure shift, so this is a textbook trade for our model, that being the unicorn model. And this is ideally what we're looking for. It's got every single confluence that we would need to take a trade. An invalid breakaway gap is one that is not within our macro times, so it's not really got any relevance to us, as we always look for trades within the actual macro windows. Here's an example of a bearish breakaway gap. So you can see that this candle has displaced through swing low, creating a fair value gap within inside of it, and it's also paired with a breaker block. As you can see in this example, the breakaway gap, price never actually disrespected this bearish gap until we actually met the draw below, which was here. So price is constantly respecting these gaps. This isn't a valid one anyway. This is one we'd actually look at because it's not within macro times. This is at 1:30 PM. But for an example, if we seen this within macro time, then this would be an absolutely lovely setup. So yeah, in this video we covered what a bearish breakaway gap looks like, and then also a bullish breakaway fair value gap looks like. So the key notes to take away from this video is that the fair value gap has to be below the swing low when this candle breaks through it. So you can see that this fair value gap is lower than the swing low. We broke through it with volume, and we've left fair value gap after the swing low. And it's also good to see these breakaway gaps with a break block or a mitigation block paired with it. That's what we'd only take it with anyway. We wouldn't just be looking to take a breakaway gap on its own. We'd need other confluences such as a breaker block or a mitigation block. This would also be paired with our actual bias from how we determine bias using fair value gaps as well. So it wouldn't just be these two confluences on its own. And it always tends to have a market structure shift as well that it leaves. So there's the market structure shift. You've got massive volume pumped into the market, So it's showing you that price is intending on going lower towards the draw, which would be down here. So I hope you enjoyed this video, and thanks for watching.